Welcome to the big interview on today's show. I am always happy when I get to chat with Marc Chaikin. He is the founder and chairman at Chaikin Analytics. If you want to learn more, it's chaikinanalytics.com. If you want to follow him on Twitter, he is at Marc Chaikin, Marc with a C. And the firm is on Twitter at Chaikin Analytic. And by the way, if you want to get all that information, if you weren't writing it down, go to the Money Life Show recent guest page, and you will find Marc Chaikin there, and you will find links to everything you need to learn more. Marc Chaikin, Happy New Year. Good to have you back on Money Life.
Chuck, it's great to be here. Happy New Year to you and your audience.
We are living in a really interesting time because, a year ago, we went through all of the market conniptions and all of the trouble that we had leading up to the rally that occurred right as Santa Claus arrived. And everybody entered 2019 fearful and scared, and they turned out to be very happy. This year, well, the market was so good in 2019 that everybody's entering fat and sassy, and yet there are reasons to be scared. But it's not necessarily reasons to be scared like, oh, the market's going to go to hell in a handcart tomorrow. It's reasons to say, oh, can this continue? Look at this. It compares. You've seen a lot of history. I'm not calling you old, but you've studied that history. So when you look at this market, what do the conditions we see right now remind you of? What is this similar to? What's the lesson you want people to hearken back to?
I liken the current market to the late stages of the bull market in the 1990s, but not in terms of the excesses, just in terms of the longevity. I think we've got a really solid bull market in progress. I think that it's important for people to look back at 2019 to understand what really happened, because the headlines don't do it justice. In 2018, earnings were up over 20%. Now, why did that happen? Because we had a big corporate tax cut. But what did the market do? The market was down about 5%. So you had PE compression, price earnings ratios just compressed in 2018. 2019, earnings per share for the S&P 500 didn't do nearly as well. We had PE expansion. So it's important to put that into context, because now we're in 2020. Earnings are expected to be up, let's say, in the 4 to 5% range. And so now it's not going to get done on PE expansion. It's got to get done on forward guidance, on actual top-line revenue increases. And I think they're coming, especially if you're looking at the right industry groups, the right sectors.
So which are the right industry groups and the right sectors?
That's been pretty clear for us all through the fourth quarter. I think it's also important to note that a lot of the concerns from 2019 are off the table right now. It doesn't mean they can't come back. China trade deal has been signed. The Fed, as of October of 2019, they basically said, we're hands off for the next 15 months. And Recession Watch, anybody who was on Recession Watch was looking for Rip Van Winkle, to use a New England analogy, since you're up there in Massachusetts, comes around once every 100 years. Obviously, recessions happen a little more often than that. So the three biggest concerns from 2019 are right now off the table. We can add Iran to that. I think we've seen that there's not a lot of appetite in either Washington or Tehran for a protracted conflict. So what's 2020 going to look like? Well, it's going to be a shift away from defensive stocks, continuing with an emphasis on cyclicals. So the sectors that are going to do well in 2020 in our work, and that's based on the Chaikin Power Gauge rating, our multi-factor model, our technology, healthcare, and financials. And when you drill down on those sectors, you find really interesting industry groups like IT consulting, like software, semiconductors. Within healthcare, medical equipment, biotech doing extremely well. Within financials, you've got the major banks, you've got some of the investment banks like Morgan Stanley that were reported recently. You've got companies like Raymond James doing really well. There's a lot to choose from in this market. The biggest concern I have, and I'm not scared, is that prices are overextended. Everything that I want to buy is at the top of the page. There's an interesting way to look at a stock chart. We look at ours from the bottom up because that's where our predictive model of fundamentally driven Chaikin power gauge is. But I like to look at the chart, and I'm looking for stocks that are going from the bottom left to the upper right. It's a really simple way to view technical analysis, looking for higher highs and higher lows. Well, everything I like, stocks like Bristol Myers, stocks like AMAT and Lam Research in the semiconductor equipment, they're all at the top of the page. They're at the top right already. So I think investors need to be careful to not chase stocks here, particularly with this sort of post-China euphoria going on.
Let's also talk about the fact that you have the economic conditions that you like. I looked at your most recent commentary, and it's important that my audience know that they can find your commentary if they go to the ChaikinAnalytics.com website. One of the things that you pointed out was that, well, we're also in an election year, and election years tend to be benign. But they haven't really been in recent history. I mean, 2000 was a bad year for the market. 2004 was not a good year for the market, certainly. And 2008 was an, oh my God, awful year for the market. So we have seen trouble arise around election years, even if it's not what we think of. Does the election politics, I mean, you mentioned the Middle East and said, as I agree with, that they're backing away from things rather than ramping up tensions. But are you at all worried about the headlines we're reading being the problem, or is the next real problem going to be something that we're not even hearing about yet?
Well, I think the election year analysis that you've just done is very important, but there are some caveats. 19 out of the last 23 presidential elections, the market's been higher. In the group where it's been lower is 1932, so I'm looking back a little further than you, 2000 and 2008. So you're absolutely spot on there. That's why we have 4 what we call recession watch indicators, because the thing that could derail the stock market would be an impending recession. All 4 of our indicators are on life support. They're just not even breathing. There's no hint of a recession. So the only thing that would really get me concerned is if there were signs of a recession, so we could then fear something like 2000 or '08 or going all the way back to 1932. But there's another trend, Chuck, in the election year cycle that's important. If the incumbent wins, the stock market tends to be up for not in a straight line, but for a good part of the year. If an incumbent loses, the market is a lot more choppy, tends to be higher but not as high. So the polls are going to make a difference this year, particularly with the Democratic Party split between progressives and more middle-of-the-road candidates. How the caucuses go, how the primaries go, how the nomination plays out is going to make a big difference. For instance, if someone like a Michael Bloomberg were to win the nomination, that would be more like Donald Trump being reelected. Pro-business, progressive, but fiscal conservative and so forth. So there are a lot of variables here, but the key for me is I don't see any signs of a recession.
Well, that, of course, great news. And that being the case, you see no signs of recession. So typically, let's use that, see if we can turn that into an indicator. How long does that normally last? Or, when you see no signs of an indicator, just like some people say, oh, you look at the yield curve inversion, which we had for a hot minute, but not for much longer. And some people are thinking this time that's not going to be a signal. When we have a yield curve inversion, they say, 14 to 18 months later, you have a recession. When you see no recession, when there are no signals, how long does that usually mean recession is away?
Well, that I don't know. So it's a really good question. When I see no signs of a recession, I fall back on the technicals, because the technicals really rule in an economic environment that's either benign or expanding. This is what I would call a Goldilocks economic environment. No interest rate, low interest rates, no hikes in view, modest growth, but we're the best game in town in terms of the various economies around the world. So hard to say. I'll tell you this, that valuations have never proven effective in calling a market top. And although some segments of the market were overvalued, there's been a lot of self-correction, especially in the IPO markets. After the big run-ups, you had a lot of self-correcting in some of these IPOs that didn't do well. So I think we're in a period where you look at the fundamentals, you look at companies that are reporting positive guidance with their first quarter earnings reports, companies that are beating estimates, both on the top line and the bottom line. So bottom line's a lot easier to beat than the top line. And you just ride the trend. That's something that people need to understand. The final phase of a bull market is a period where you make an awful lot of money. It's what I call blue sky territory. And why do I say that? Because there's no logical resistance. So when I wrote my market letter last week, I basically said there's no upside resistance here. Round numbers are all you can use as a guide until we've had some sort of correction. So 3,300, 3,400, 3,600 potential resistance areas, but blue sky territory is when you make an awful lot of money in the stock market.
Let's hope that it works out that way. We will check back with you in the not-too-distant future to see if the skies remain blue, if there are clouds coming in, and how long we can go without you seeing recession on the horizon. Marc, thanks so much for taking time. As always, I very much appreciate it. I'm already looking forward to the next conversation.
Jack, a pleasure. Thanks so much.
That's Marc Chaikin, everybody. He is founder and chairman at Chaikin Analytics. If you know the name of the firm, well, you can go find them online, ChaikinAnalytics.com, and you can find Marc's market commentary, as he talked about, and just drop the S at Chaikin Analytic on Twitter. Marc's on Chaikin personally. He is at Marc Chaikin, Marc, M-A-R-C, Marc with a C. All right, we are halfway into the Friday, January 17th edition of Money Life. But halfway means we are just picking up speed. Stick around. There's much more Money Life to go, including a market call that will feature Thomas Kirchner from the Camelot Event Driven Fund. We'll be right back.